Distinguished guests, panelists, ladies and gentlemen, good morning from Tokyo. Welcome to the workshop on transition finance in Asia. I express my gratitude to the panelists from IOSCO, ABAC, Adbi, APEC, SFDN, Malaysia, Japan, and Australia, and those from private sector, including global asset owners, global commercial banks, asset managers, investors, and corporations, accounting firms, and valuation organizations, and participants from governments of the ADB member economies. Thank you very much for taking the time to join us today. According to financing roadmaps of Glasgow Financial Alliance for Net Zero, $125 trillion of investments are needed for the global economy to reduce emissions to net zero by 2050. And the Asia-Pacific region is expected to account for a relatively large portion of the necessary investments, given its growing energy demand. To finance the low-carbon transition investments, multilateral development banks should play an important role. Also, it is clear that the mobilization of private capital is indispensable. The private capital mobilization to transition finance would, in turn, require the creation of fair and clear guidelines, rules, standards, and taxonomies, as well as innovative approaches, including the blended finance. In the context of hard-to-abate sectors, a decarbonization roadmap should be identified for each of these sectors. More generally, many things need to be considered and agreed as to the transparency of information, disclosure of corporate strategy for transition, verifiable KPI on transition, and so on. Since the countries in the region are in different development stages, it's natural that they prefer different roadmaps for low carbon transition and different taxonomies, rules, and standards on one hand. On the other hand, global investors would prefer the unification of these things. Such conflicting interests need to be reconciled. I hope that this workshop will foster constructive conversations and dialogues among investors, issuers, regulators, and other experts for boosting transition finance in Asia and Pacific. Increasing and improving communication is the first step toward solution finding. Thank you again for taking the time to participate in this joint effort. I hope you will have truly fruitful discussions today and tomorrow. Thank you very much for your attention. Over to you, Keiko-san.
Thank you very much for your remarks, Dean Sonobe. Next, we will have two distinguished keynote speakers for our event today. First, I would like to have Mr. Carsten Quitter, Chief Investment Officer of Allianz, as a keynote speaker. Mr. Quitter held various management positions at Swiss Re in the areas of risk and capital management and alternative risk transfer. Before joining Allianz in 2005 as a CIO, he held various posts in Switzerland, the United States, and most recently, Italy. As Allianz Group CIO, he is responsible for asset liability management, strategic asset allocation, and investment strategy for all Allianz insurance portfolios worldwide of about 800 billion euros. Mr. Quitter also serves as Managing Director and Global Co-Lead of AIM. His remarks has been pre-recorded. In a video, Mr. Quitter shares his remarks on Allianz's commitment to transforming investment portfolio to net zero emissions in view of the Paris Agreement, along with collaboration with like-minded stakeholders. He expresses his expectation for Asia in his efforts in meeting net zero emission goals.
Thank you for having me, also in a virtual format. And it is an honor for me to share Allianz's view on financing the transition of the economy as an opening to your 2 days workshop. So, the challenge we are confronted with, the climate crisis, is there. You see on the cover page these colorful stripes, and if you move to the next picture, you see what is behind that. It shows the development of the temperature since the beginning of the Industrial Revolution until today. And you see we are at the very hot spot in 2022, record temperatures all over the globe. And we have already achieved at 1.2 degree warmer climate than at the beginning of 1850 of the Industrial Revolution. In Paris, the world committed themselves to a 1.5 degree pathway to be achieved by 2050, but in the moment it looks we are not on that pathway. We have a 2.7 degree trajectory right now, and if we continue with the CO2 emissions as of today, we have just 7 years of the budget left to achieve 1.5 degrees. That means we have radical transformation of the economy ahead of us in order to get back on that pathway. This really needs strong financing. It's a global challenge and the huge financial gap we have to close. Let's have a look at the numbers. So on the next slide, you see what GFunds has analyzed as the financing requirements. In order to achieve 1.5 degree, it's about 125 trillion of US dollar necessary, of which in the next decade alone, it's 32. And Asia is contributing to that with an almost 14 trillion US dollar number. So while this is a huge challenge and financing gap, it is also offering a huge opportunity for institutional investors. But we cannot do this alone. And you see here that it needs a triangle of public sector, the real economy, and the financing economy to work jointly together in order to set the frame for organizing this financing, the transition of the economy. We, as Allianz, want to contribute to that. We have committed ourselves to a net zero path by 2050 for our whole organization. And we have a more than 800 billion of investments which we committed to become net zero by 2050. And we even agreed on shorter term targets to reduce that by 25% already by 2025 for many of our asset classes. We want to do this comprehensively on all our asset classes, and we want to achieve a real world impact. And therefore, we have ESG criteria, ESG scoring, which helps us to guide us through that process. And we also engage with our counterparts in order to get on these pathways so we can achieve our targets. We are not alone, and we cannot do it alone. So we were one of the founding members of the UN convened so-called Net Zero Asset Owner Alliance, which is a combination of like-minded investors who all want to be on that path. Together we are stronger. So looking at this Net Zero Asset Owner Alliance, you can see that it's over 70 institutional investors with more than 10 trillion of US dollar assets under management. And while the majority is still coming out of Europe, there are more and more coming from the Americas, the rest of the world, but also from Asia. You see here the 6 participants on the slide from Asia. On top, there are many institutions, supporters, NGOs, and partners who jointly work in that alliance, joining forces, sharing research, and being one voice at that table with the triangular partners. Asia has actually stepped up a lot already. There's a great momentum when it comes to ESG. You see more and more initiatives being launched, and you also see a variety of individual progress, be it signatories of the PRI, be it the number of issued sustainability bonds and the like. So there's a strong momentum building, And I think we also need Asia to continue that momentum. And therefore, even further parties eventually joining those alliances will make a good contribution for us altogether. So let me give you some examples on what we did in the recent years in order to finance sustainable development, also in emerging markets and developing countries. You see here on the slide 7 examples. They are more illustrative, but in total it's more than 2 billion of investments in a special form which we call blended finance, because it brings together the stakeholders like the development banks, donor communities, and the institutional investors. So how does this work? Well, the individual projects are too risky for institutional investors like us with a fiduciary duty, because it's not our money, it's the policyholders we represent and we invest on their behalf. Therefore, we have to be prudent in that investment of their money. Therefore, individual projects do not necessarily fit from a risk-return profile in that target picture. But if you pool many of those investments and creating diversification, and if you get a structure vehicle where you have public money taking, call it the first loss position, like foreign exchange risk, like individual project risk, and the like out, but then creating therefore a senior tranche which is less risky, then this is perfectly fitting also for us institutional investors. And I think those examples here show that it's possible, but it was a lot of work and it's not that easy. So I think many obstacles are still to overcome, but it's possible if you get the right stakeholders together. So what can be done from here on, also in Asia? I think we can do more of what I just described by overcoming those obstacles. We have to find those pooling vehicles, not individual projects, which needs to be jointly invested into. We have a lack of a pipeline of projects. We have to work on getting more bankable projects into these pipelines to form those pools. We have to get the stakeholders, as I mentioned, into the loop in order to organize those first loss structures. And therefore, also the development banks need to be clear that they are should try to pull in private money and crowd it in rather than crowd it out. Still, we have today a lot of situations where the development banks are incentivized to put their own money at risk as soon as possible, which is great intent. But if you rather use it in those structured vehicles, as I said, you have the chance to really leverage the private money in, and therefore you have a much higher impact if you do it this way. There's another element, it's about data. There's the assumption that these projects are very risky, but there is data out there which can prove that it is maybe better than expected or perceived. But this data is owned by the development banks. There's a database, a GEMS database, and a lot of private investors have since long already asked, let's share that data so we can more transparently show to the world what are those investments and therefore rate them properly, which again is another boost for getting more money to finance those. And therefore, we have to shift the focus from individual projects to pools, getting those structures ready, and crowding the private money in. On top of that, what can governments also do, also in Asia? I think it's clear carbon pricing is an important element to put the proper price for society of carbon on the economic activities, and through that create the right incentives to move away from carbon-intensive energy sources. It needs a consistent system, it needs clear target setting, it needs monitoring. It's not simple, but we need more of that. Secondly, we need to end subsidizing fossil energy sources. Today, still 650 billion are annually paid in form of subsidies for fossil fuel and fossil energy sources. This needs to stop. That needs to be redirected into more sustainable forms. And last but not least, we have to set standards for reporting and making the progress transparent, because only what you measure you can manage. And there's also progress in the various areas of the world, but also here I think we can do more. So let me summarize. The climate crisis is a huge global challenge. We have to put all joint forces together to confront those challenges. We have to transition the economy in a radical way, which is a huge financing gap also in Asia, but also in the rest of the world. We can put private money to work, but it needs a triangular joint ventureship between public, real economy and finance economy. We should form alliances to bundle forces, like the Net Zero Asset Owner Alliance, but also others. We should structure vehicles which really leverage public-private partnership and bring more private money into this financing that huge gap we talked about. And we need to overcome those practical obstacles in order to really move to the next level and scale volume really up. Thank you for your attention. I hope this gave you some food for thought, and I wish you a very successful next 2 days of the workshop. Thanks.
Appreciate very much for Mr. Quitter's insightful and kind remarks, which set the scene for the event, referring to the fact that long-term investors see a huge financial gap, together with also the room for the collaboration of public sector together with financial sector and real economy. He shared some thoughts about the issues and possible solutions in Asia. Now, I would invite the next keynote speaker, Mr. Alginga, Senior Energy Specialist, Climate Change Southeast Asia Department, ADB. He's leading the energy transition mechanism at ADB. Previously at UN Economic Commission for Europe, he focuses on the role of fossil fuels in sustainable energy system. And at the International Energy Agency, he was lead author for energy technology perspective publications. He also led IEA's work on electricity system technology, such as smart grids. Over the course of his career, David has worked in energy and climate fields for over 20 years, with focus areas of technology, policy, and analysis in both private and public sectors. In these roles, he developed markets, deployed renewable and energy efficiency technologies, and has advised various governments at the local and national levels on energy policy. David will inform us about ADB-led energy transition partnership, a scalable, collaborative initiative developed in partnership with developing member countries that will leverage a market-based approach to accelerate the transition from fossil fuels to clean energy. Mr. Alginga, the floor is yours.
Great, thank you, Keiko-san, and it's a pleasure to be part of this event today and to share some of the work that we're doing at ADB. So it's a pleasure to, well, first let me just check, is my screen displaying correctly?
Yes.
Great, thank you. It was very much great to follow the last speaker, because I think some of the things that he has highlighted align very much with our objectives with respect to the energy transition mechanism. So behind the work that we're doing is we are looking at the role of coal-fired power in electricity systems globally. So when we talk about energy transition, there's often a focus on deployment of renewable energy and other clean energy technologies. But if we look on the left side and we see the share of coal-fired power in electricity systems globally, despite growth in renewables, this has, on a global basis, remained flat. We see that in some regions, such as Europe or in the US, we've seen the share of electricity or of coal-fired power in electricity has decreased. But when we look to the right-hand side and look in Asia, we see very large shares of coal-fired power in electricity systems and low shares of renewables. So this really indicates that if we want to make the energy transition, we have to address existing stock and addressing coal in power systems as one of the key issues. So as part of this, we launched the Southeast Asia ETM partnership at COP26, and I'll share what exactly we're trying to accomplish. But largely, as suggested in the introduction, we're looking to create a mechanism that can accelerate the early retirement of coal-fired power plants and invest in clean energy. So looking at both sides of the coin with respect to the energy transition. So at the launch at COP26, we were joined by the Indonesia and Philippines, where we are working alongside Vietnam as well, to launch this partnership. And we received some support from a number of our member countries. Japan Ministry of Finance provided us with our first seed funding into the ETM, which is often the most difficult to get. So that was greatly appreciated. But we also received endorsement from a number of ADB member countries, such as Denmark, the UK, and the US, and as well endorsement from a global leading financial institution, as well as working with philanthropies. So this really validated the interest in this idea, the agreement or endorsement of the rationale that we have to address coal-fired power as well as invest in clean energy. So this is how we're trying to establish this. Now, this is a very full slide. I note that, but I wanted to share how ADB as an institution is trying to implement a practical mechanism in order to support the coal to clean energy transition. Within ADB, we've set up the ETM Partnership Trust Fund, and this allows us to accept donor support of grants and highly concessional funding that then can be deployed later into specific activities. Within this partnership, we will have a steering committee that includes both the donors as well as the developing countries themselves to help with the governance and agreement on how this money is used. It will also include oversight to ensure that we are making net climate benefits with the deployment of ETM funds. And lastly, just transition is a key aspect, and we will deliver on these activities through the trust fund and make sure that they're coordinated both with ADB, Just Transition Facility, but other national or regional activities that are carried out. Now, when we go to the middle of this graph, or the right-hand side, we look at some different ways that we can deploy ETM funds. The first part, which we've talked about from the beginning of the development of ETM, is an ETM fund or vehicle. So this very much aligns with the previous speaker who indicated that, we need to create these approaches that can blend in other support from IFIs, but also international and local investors or lenders from the private sector who can blend with the concessional finance. And in this context, the vehicle could do multiple transactions, both at the carbon reduction facility and the clean energy facility. So allowing us to invest in the accelerated retirement of coal plants, but also in clean energy investments. The second approach is that we need to do some precedent transactions or some first transactions, and we can do that through ADB directly. So again, this is not using only ADB funds, but this would be co-financing with other international finance institutions and the private sector. So we currently are working on some first transactions that we indeed hope to announce over the next year. And then lastly, technical assistance remains an important element of the ETM. We need to perform the technical and the financial analysis, as well as develop skills and capabilities within countries in order to deliver on this transition, and equally support policy and regulatory aspects to ensure that there is an enabling environment. So currently, Adbi is performing a feasibility study on ETM, and we're doing this at both the regional level to develop the overarching principles that can be applied in many different countries, and as well going down to the country level to very much look at the market specifics, the fleet specifics, and any other attributes found within a country so that we can develop the ETM and make it fit for purpose within specific countries. It won't be exactly the same as countries differ in certain aspects that must be considered. But alongside of the technical and the financial aspects, key to the ETM are safeguards and just transition. So we are currently working at both the regional and then moving to the country level to ensure that environmental and social aspects are addressed in the coal retirements and the shift to clean energy. And as well on the just transition, which is somewhat of a new topic that has really taken charge over the last number of years, looking at the impacts on the people and communities that depend on coal-fired power plants for their livelihoods, and developing mitigation measures or activities that can support them in this transition. That could be the development of new industries, as well as shifting to work or livelihoods around clean energy technology. So lastly, I want to just highlight that over the last year, we very much were working towards COP26 as the culmination of our work in 2021. This year, we're looking very much to the G20 and COP27, structuring the ETM, developing the pipeline of potential projects to announce at those points, especially this year in Indonesia. The G20 is being hosted here in the country, and there is a tremendous amount of political momentum both in Indonesia as well as from the donor community, and as well at COP27 to announce our work and implement following that in 2023. So we're very much working to prepare a plan that can be announced and implemented, that we can take real action on the coal to clean energy transition. So I'll pause there. Thank you for the opportunity to share ETM. We believe that this is an important aspect that must be addressed for the just energy transition. It is a challenging one. It is one that might be less comfortable for financial institutions. It's easy to do the good stuff, the clean energy, but we must address the existing stock, find ways to accelerate the retirement of coal-fired power plants, and we believe that the ETM can be a mechanism to support this. Thank you.
Thank you so much for your very insights and informative remarks at the presentation. Later, some discussion at the sessions will refer to ETM, and also some of the speakers expressed the expectation associated with the Adbi. So you really gave, from this perspective, also you gave me a great lead for the discussion later. So thank you very much. Now, before we move to the first session, I'd like to take a group photo.
So good morning. For all the speakers, please turn on your camera.
Nathan, please take a picture when you're ready.
Okay. Okay, I'll count to 3. 3, 2, 1, smile. One more, please. 3, 2, 1, smile. Thank you very much.
Well, thank you, everyone. Now we will have the first session. In this session, we will discuss the global market structure in view of the financing transition in Asia. I would like to introduce the moderator of the first session, Peter Morgan, Senior Consulting Economist and Advisor to the Dean at Adbi. He previously worked in Hong Kong, China as Chief Asia Economist for HSBC, where He was the responsible for macroeconomic analysis and forecasting for Asia. Before that, he was chief Japan economist for HSBC and held comparable positions at various institutions, including Merrill Lynch, Barclays, and Jolly Fleming. His research focuses on macroeconomic policy and then financial sector regulation, reform, financial development, financial inclusion, fintech, financial literacy, and financial education. He earned his MA and PhD in economics from Yale University. Peter, the floor is yours.
Thanks so much, Keiko-san, for that kind introduction. So I'm delighted to chair this a very important session on global market structure, financing transition in Asia. So the background is that, hold on a second. We want to promote knowledge about the global financial market structure, including types of transition finance providers, target instruments, target sectors, criteria used for transition finance related decision-making, and specifically to identify experiences and expectations of global investors and lenders on transition finance in Asia, and also to identify challenges and possible solutions associated with transition finance to promote transition finance in Asia from the viewpoint of global investors and lenders. So to help us on that, we have three very experienced panelists. So let me introduce them very briefly, because the full bios are given in the conference materials, but first was Dr. Dina Ashkalieva, my colleague. She's a research fellow at ADBI. And before joining ADBI in July 2019, she worked as a research fellow in the Energy Economics Division of the Energy Studies Institute at the National University of Singapore. Our second panelist is Jennifer Zhou. She's director at Standard Chartered Bank. She has over 10 years of experience in corporate finance and sustainable finance, and has a deep knowledge of TMT, power and utilities, and renewable energy sectors, working as a sector specialist in these industries and providing capital market solutions. And our third panelist is Jason Mortimer. He's head of sustainable investment, fixed income, and senior portfolio manager at Nomura Asset Management in Tokyo. Jason is focused on fixed income, ESG integration, and sustainable investing in fixed income and credit, as well as green social sustainability bonds and other mainstream impact investment strategies. So each presenter has 5 minutes. Let me give the floor first to Dina. Thanks very much.
Dear Peter, thank you so very much for your kind introduction. So I prepared a few slides to make my presentation more visual. So about Asia and the Pacific region, if we look at the investments in energy transition, which investments in energy transition includes mainly renewable energy investments, clean transportation, and also some other technologies like hydrogen, carbon capture and storage, energy storage, and so on. So if we look at these investments, according to the Bloomberg New Energy Finance dataset, Asia Pacific region accounting for nearly half of investments in low carbon energy transition in 2021. And we can see that since COVID-19 started in 2020 and 2021, investments have been growing despite the onset of COVID-19. The structure of investments in energy transition actually changing over years as technologies are becoming more mature. Some of the technologies. So previously it was dominated mainly by renewable energy and mainly by solar and wind due to a quite competitive cost of solar and wind. But over recent years, electrified transport started to grow quite significantly due to great great government support and some cost reduction. Unfortunately, our technologies still have very small share of investments, like, for example, hydrogen. It shows 0%, but actually it's positive number. It's just very, very small, like carbon capture, utilization and storage, and lithium-ion batteries, like energy storage. So currently, the investments in energy transition are dominated by renewable energy and electrified transport, mainly due to cost reduction and government support. Yeah, so as we need many technologies for energy transition. Like I said, renewable energy will not be sufficient for energy transition or for meeting net zero carbon targets. Other technologies also will be needed across all sectors. Like, for example, hydrogen and carbon capture and utilization and storage are still quite expensive technologies, especially green hydrogen. And so it will require a lot of investments in research, development, and demonstration in order to technologies to grow, go through these stages from technology research to manufacturing scaling up, for example. Yeah, and in order to produce such technologies and then to install them. Yeah. So our recent research, we looked at Adbi, we looked at the structure of investment. So it's very important to look not only overall investments and which technology invest, which countries, but also to check where funds are coming from in terms of the structure, like asset finance, public market, or venture capital, or corporate research and development. So this figure shows the results of our recent research across 4 sources of financing. So that's, as I said, asset finance, public market, venture capital, and corporate research and development. And then on the horizontal axis, we show the impact of investments in renewable energy. So right-hand side is a positive number and left-hand side is a negative number. And then also separately for Asia and for overall sample. So this data set, by the way, it's from Bloomberg, includes a number of countries, including Asia. Yeah, so the result shows that not all policies have same impact across all sources of financing. So different policies affect differently sources of financing, and especially that this very interesting, the negative impact of the taxes incentives on venture capital and corporate R&D. So tax incentives, for example, including exemptions of or reductions of import duty on renewable energy, increase the total private investments in renewable energy, but unfortunately shows negative impact on research, development, and manufacturing scale up. And also impact of policies in Asia. For Asia, we included People's Republic of China, India, Japan, Republic of Korea, on investments in renewable energy have a stronger impact than in other regions. Yeah. So this result shows the importance of studying the structure of finance, the sources of financing, not only the overall renewable energy investments. Thank you very much.
Thanks very much, Dina. Very interesting results. So our next presenter is Jennifer Zhou. Jennifer, the floor is yours. You have 5 minutes.
Thanks so much. Very happy to be here, and good morning, everybody. For my session, I'll be discussing how Standard Chartered Bank looks at net zero and transition. Sorry, first slide, please. So we have 3 key commitments. The first being reducing our finance emissions. So this includes our top 3 highest carbon sectors: power, steel and mining, and oil and gas. We have a second commitment to finance 300 billion in green and transition projects to help our clients reach their net zero targets. And finally, we have a commitment to grow a sustainable kind of transition acceleration team that's going to help our clients with their low carbon transitions and giving them the tools to measure their progress. So given these three commitments, next slide, please. We plan to reach our net zero finance emissions goal by 2050 in line with the Paris Agreement. And we're already well underway in our journey. We've published our first sustainable impact report. We've already announced our targets and set them. And currently, we will only provide financial services to clients who are less than 5% dependent on revenue from thermal coal. Next slide, please. We have divided our clients into three key categories. We have green, we have orange, and then finally we have red. For the green clients, we plan to grow them. They are already on their pathway and they don't need much help from us. So these would be some of the renewable energy clients, for example. For our orange clients, we're currently on a hold status, but we will make an eventual decision by next year to allocate them to either on the pathway or not on track. And what we will do is have in-depth discussions with these clients to understand their transition plans, to see where we can help them in terms of financing or advisory. And then finally, next year we'll decide on whether we hold them or if they're not on track, we might reduce or exit those clients completely. Next slide, please. The way that we plan to mobilize 300 billion in transition financing is via the transition finance framework that we have. So we have created a framework that was issued at the end of last year based on a few different principles. The first being that it's compatible with the 1.5 degree trajectory established by the science-based targets, that it doesn't hamper the development or deployment of any low carbon alternatives or lead to a lock-in of carbon intensive assets. And finally, that they meet the safeguards defined in our environmental and social risk management framework. So this is kind of how we've defined transition. And this transition framework is complementary to a green and sustainable finance framework that we have as well. And the key elements of the net zero emissions by 2050 scenario, IEA, are also aligned to our green and sustainable product framework. Next slide, please. Here I've put a few examples of what's included in our transition finance framework. So we have a variety of different sectors ranging from aluminum to iron and steel to agriculture all the way to cement. So here are some qualifying activities that don't really fit into green, but we can't deny that they are indeed helping the environment and helping our clients to decarbonize. So we put those under our transition finance framework. Next slide, please. And finally, I wanted to give everyone an introduction to our approach to net zero. So how are we even calculating our emissions, our finance portfolio? So first, we've set a baseline based on our 2020 finance emissions. And we've kind of looked at about 77% of our financing. And then we projected kind of both the net zero and 3.5 degree scenario up to 2050. And then the gap between these two different scenarios provides an initial measure of that decarbonization challenge that we face. And then this is further defined at a client level by assessing their individual decarbonization commitments and their transition risk mitigation plans. Finally, we've looked at the 3 high emitting sectors I mentioned earlier. And we kind of decided what we want to do in the near term. So 2050 is our long-term goal, but we wanted to kind of set a milestone in 2030 as well. So in oil and gas, we want to reduce our emissions by 30%. In metals and mining, it's about 33%. And then in power, it's about 63%. So we need to work with these clients in these sectors to get them on the right path so that they can meet this kind of transition reduction target. And our new transition financing team is kind of the center of all of this. We are hiring experts from industry themselves with deep ESG knowledge to provide not just financing to our clients, but that kind of advisory that they need operationally and so on. Finally, we plan to kind of monitor our emissions targets, our projections, and then improve them over time as needed.
So those are kind of all of the slides that I wanted to go through today. Thank you.
Okay, thanks very much. We've had three, I think, very brief but intensive presentations. So the floor is now open to questions. So please type your questions into the Q&A box, and I will present them.
So yeah, Jason's presentations.
Oh, I'm sorry. Very sorry. Yes, Jason, the floor is yours.
Oh, thanks so much. Could I please have the slides up? So while we're getting those, I work at Nomura Asset Management. We're an asset manager in Asia and in Japan. Obviously, I focus on the fixed income side. I'll be discussing kind of financing transition in Asia from our perspective, which is fixed income and especially credit focused, and what I and my team are doing to build this into our process, not just in for our net zero commitment as a whole as a company, but really where the rubber hits the road, how we're doing this in our portfolios, our security selection, portfolio monitoring, and so forth. So if you go to the next slide, please. First, let's talk about, let's just put some numbers on this market. As part of the green, overall growing green sustainability, the labeled ESG market. And we did see in 2021 about $1 trillion worth of issuance in this entire labeled bond stack, as you can see up in there, upper left hand, number 1 slide. And I've labeled out green, social sustainability linked, and a tiny sliver, which is almost invisible, of actually transition bonds. So what we do see is that sustainability linked bonds in 2021 made up about 12% of the market, and that market share is growing a little bit in 2022. As of the first half, that's up to 14%. So we see that after some COVID pandemic related increases in the social bond issuance, green and I think also sustainability linked is really kind of taking market share again in this large growing market. And if we kind of break that down by who exactly is issuing, what I've done on slide number 3 is to pull out just the transition sector, what we would define kind of as transition sectors, their sustainability linked bond issuance. So transition sectors here being chemicals, cement, steel, metals and mining, oil, gas, ocean transport, power generation. And we're excluding the financials from this. So again, this is overall indicative of the larger ESG and labeled bond market, but you do see that Europe is quite a large part of this, about $28 billion worth of what we would call transition sector sustainability linked bond issuance in 2021, and tracking for about 32 billion this year. However, Asia is a relatively small part of this market. It's only about 6 billion for last year, and probably on track for about 6 billion this year. So what we can take away from this, and what we do find in the market, is that basically sustainability linked bonds have become a sort of a de facto transition bond in Europe. And we'll discuss some of the reasons for that and some of the challenges we think in a little bit. The transition bond itself, that market is now almost entirely an Asian and specifically Japanese market, as you can see in chart number 4. So label bond issuance by period and country. Note the very large change in size here. We're talking in single digit billions. Issuance has ramped up somewhat, broken down by quarter, almost all from Japan. I think I credit that a lot to a lot of work by the Japanese government and regulators to put quite a lot of meat on the bones of transition financing pathways, putting out a lot of examples that are very useful for us to see, talking about this issue, whereas in a way that we don't really get in Europe. And I think that's why you're seeing a bit more of this transition sector labeled bond issuance. Although some of our colleagues in Europe seem to believe that this is kind of not really a real market. So we'll have to see how that develops going forward. One thing I will say, sustainability linked, whether it's transition finance being done through sustainability linked format or kind of an emerging, and possibly soon to come, transition bond label. The good thing about the sustainability link, obviously, is that it does allow the issuer to kind of focus on their overall sustainability goals and KPIs, and for us to track that at the top level, which is certainly useful, although it does have its own drawbacks, namely that the KPIs are not always set in a very ambitious way, and a lot of them are quite far out in the future. So it doesn't give us quite that level of necessarily the level of granularity and detail that we'd like to see, which you do somewhat get more from the transition bonds and the transition format, where we can take a look more in a way that's not so common for us, because we're not necessarily project financiers. We are investing in listed corporate bonds here. It gives us a better transparency into some of these projects, so that is welcome, and I think it's part of probably the market will need a little bit of both. If you could take me to the next slide, please. So here is Nomura Asset Management's emerging approach to evaluating transition finance. And for that, I'm actually talking specifically about the types of investments that we make in those transition sectors that I just mentioned in the previous slide. And it is actually part of an overall kind of approach to net zero credit investment that we're developing now and putting into practice. And we think that given our capabilities and the expertise and our ambitions that we want to do this, right now the best approach for us and what we're doing is to take a multi-layered assessment approach in our portfolios. So the first is that we set the strategic objective, which is that we incorporate top-level recognition of the legitimate need for transition finance into the fund's overall climate investment objectives. And that's based on an objective cost-benefit assessment that we think is really necessary going forward. I mean, in kind of energy terms, you could think of the energy generation carbon intensity that we're looking at, but also considering energy security, energy density, energy dispatchability, and energy affordability. I think it's really a key idea to keep in mind going forward, that my own personal view is that without kind of resiliency and kind of energy security, for example, it's going to be very difficult to pull off energy sustainability in the long term, as we do continue to get buffeted by these shocks and crises. One of which is obviously playing out right now in Europe. So that's something that we want to build in to our overall climate objective, investment objective, but give a home for transition finance as a legitimate part of our investment towards net zero in a thoughtful and controlled way. And at the portfolio level, we're integrating climate risk controls within the investment guidelines for indicators such as overall carbon intensity of the portfolio, science-based target commitments. We can track that across all the issuers in our portfolio and see how that's progressing over time, and the level, the pledge quality and the ambition level of that. The actual level of decarbonization recently achieved. The portfolio implied temperature alignment model results. This is kind of a new and we think interesting way of looking at, and in kind of in the one number, what is your portfolio aligned, what temperature scenarios are portfolio aligned to, and also that can be done at a individual issuer level. So it gives us a lot of granularity and another way of looking at this that's a very intuitive way to understand it. And it does not necessarily mean that we're going to be putting in sector exclusions. That is not the approach that our company takes, and that's not the approach that we're taking for our net zero credit portfolios either right now. And that also kind of that sort of top down assessment also fits in with our issuer level assessment, which I'll explain in a few seconds. So at the sector level, we're also designating those sectors which we think have faced the current technological limitations to achieving net zero based on recognized sector roadmaps. And those with a high level of support to critical national functions for provisional inclusion and subject to enhanced screening. So these are your typical hard-to-abate sectors and certain energy and power sectors, not necessarily everything. We're certainly not going to be, considering, for example, a coal mining company in Asia as part of this. But in certain sectors, I think it is important to consider, what the sector and that issuer potentially is contributing to critical national functions for the country that are really important for us to continue to support throughout the transition, and to provide capital so that transition can be done in an economical and kind of a sustained way. And at the issuer level, sort of the bottoms up side of our top down portfolio assessment, we're screening out those portfolio issuers with the high ESG credit risk levels based on our own internal scoring models. That's sort of like a kind of a base level of protection that we put in, but also assessing and going forward, assessing each issuer's net zero alignment level over time based on basically a 40+ factor quantitative scorecard that we've developed, looking kind of at every little aspect that we can track of their net zero alignment journey and how they're progressing on that relative to their peers and also relative to our own expectations for our net zero portfolios, subject to minimum inclusion standards that we think are good, that are going to rise over time. So we can track this, we can turn this very complicated analysis into kind of a trackable quantitative figures that we can kind of subject to rising standards and portfolio controls over time to shape the portfolio in a way that we think makes a good balance of sustainability and also kind of the affordability and energy security, for example, in those sectors. So really seeking to balance climate risk with socioeconomic impact. Then at the framework level, we're also looking at bonds at the bond level in analyzing projects and assets for country-specific policy roadmaps. That's very helpful to have, especially in the case of Japan, where they're pretty much all being developed for us, and from with support and the view from the government. That's very good to know where that support is coming from, and what we can use as an official guidepost for the roadmaps. The support level, the national strategic interests are taken into consideration, and the project level risk as well. Finally, certainly on the transition of green and brown, you have sort of transition from green to brown types of projects. For example, an energy company transitioning from, let's say, fossil fuels to more traditional forms of renewable energy, sort of transitioning, enabling technologies that are not necessarily themselves going to be counted as green, but are certainly, we think, very important for enabling the transition to happen, and for green and important for green technologies and renewable energies. And then at the kind of the forest level of risk, which we are still working on how to make this work. Those kind of very hard to abate, but also hard to fund sectors, sort of the R&D for new tech specifically. That one is is sort of the next frontier for us. If you could go to the next slide, please. Now,
could you wind up in 1 minute, please?
Sure. Okay, so the current challenges that we see for investors in transition finance, really, this is, we got greenwashing fears. There's no market consensus on the definition for transition finance. It's hard to assess. Again, there's really no taxonomies. It's probably very difficult to, I think, put out a taxonomy globally. Brown stigma, the taxonomy transition in the discussion in the EU is very controversial. It seems like we're at loggerheads there. Asset stranding risk, the disconnect between intermediate needs and long-term investments, and then also the idea that this is not needed or there's no time. So green investor incentives basically, I think, are kind of aligned against transition, as green investment is very much about kind of keeping those kind of brown investments to zero, whereas we think that maybe there is a necessity for keeping that more in a more reasonable way. So basically, to round up, we think that we need standardization and guidance from our market participants. Roadmaps are very helpful for that. Official commitment and support from policymakers. That's starting to come from Japan, we think, but more could be needed. And honest debate of the costs and benefits for society, because this is going to, the transition is going to be costly, and we need to have that honest discussion. Thank you very much.
Okay, thanks very much for three very detailed presentations. We have a question from JC Pareñas for all the panelists. How do, first, the acute shortages in oil and gas due to the geopolitical conflict over Ukraine, which are having significant economic and social impact, including growing protests in Europe and the US by fuel users and consumers, and two, moves to revive coal and oil production in response to these pressures, how do these impact discussions on ESG finance in financial institutions and governments? So anybody's welcome to respond on that. Jason, do you have a?
Yeah, I will take that. Look, the situation is playing out right now. I mean, we basically have kind of anticipated some of these moves. From about 2021, when we saw the big increase in demand overall rebounding from the pandemic, we knew that given the lack of kind of capex in some of these sectors, that we were potentially going to be facing some supply bottlenecks. So we've actually built in some degree of this concept, like I said, for energy security and energy resiliency into our frameworks, both at the corporate and sovereign levels, that we think is important to take track of. So again, it's all part of. We think it's important to kind of have a place, give a home for transition, so that this energy transition can be done sustainably. Again, it really is going to derail the transition if prices rise, 5-10 times, and no one has heat in the winter. That's just not going to be sustainable. So we need to really try to continue to provide financing to those sectors, make sure that those sectors are supported and we can do what we need to do, and that the overall package is consistent with a long-term decarbonization and transition. Thank you.
Okay, thanks very much. I don't see any other questions in the chat or the Q&A at the moment. I have one question. How could ADB, in cooperation with private sectors, contribute to investors and lenders' decision-making regarding transition-related instruments? Jennifer, would you like to respond to that?
Yeah, sure. I think ADB has been a huge partner for Standard Chartered, particularly in terms of blended financing. So I think the most obvious answer for me would be to do more blended finance kind of facilities to help transition, because the countries that need to transition are very much aligned with, first of all, Standard Chartered's footprint, as well as ADB's kind of focus. So I think through those blended finance instruments, I recall we did a blue bond for the government of Seychelles together. These kind of deals really help to get financing where it matters most, and where there may be difficulties in terms of getting that CapEx funded.
Super quick for me, I'd like to say, it's very useful to have roadmaps available from the public sector, from the official sector, and the type of kind of third-party credibility that ADB can lend, either as a partner for financing, or as a third-party objective provider of information for us to know what we need to do. For example, what's the sector-specific decarbonization rate that would be expected. Something that we can kind of very, very readily put into our processes. That would be a very helpful piece of information to have from ADB, especially on a country-specific level in Asia. Thank you.
Now I have one question in the Q&A for Jason. You mentioned roadmaps, which are developed by the Japanese government. However, roadmaps do not include quantitative information. So I would like to know how to use roadmaps in investment decisions. Thank you.
Yeah, I mean, basically, roadmaps give us, well, there is in some cases quantitative information in those. For example, what's the overall level of decarbonization that's required on a sector level basis. We start to see these being rolled out. For example, in the Climate 100 Plus has done some work on that. But what basically this is telling us is, what are the questions that we need to ask? We recently started to hear from some issuers of transition financing or even transition bonds. Basically, I mean, for putting us in the seat to have to analyze very, very long dated, kind of never been done before types of technologies and projects to finance. Having the roadmap in place gives us a starting point to do the research, to understand what is feasible, what are the risks involved. Is that something that we actually are comfortable for the long term, and that we think is aligned not just with sustainability of the energy transition, but also sort of providing a resiliency of energy to the country. So those are kind of the ways that we're using roadmaps to build out those scorecards and our own as the basis for our own research. Thank you.
Okay, thanks. Finally, Dina, do you have any thoughts on the role of ADB or the government to promote transition finance?
Thank you very much, Peter. Yeah, I think this is very important questions asked to panelists. Yeah, I can add to this the role of international organizations, international financial institutions. Many of them committed, like for example, ADB committed to green investments, to climate investments by 2030, $100 billion US, and other institutions like World Bank also committed. And Also, some institutions committed not to finance fossil fuels. For example, in the new ADB energy policy included that not to finance new coal-fired power plants. And other institutions also have such commitments. Yeah, and I would like also highlight, especially about new technologies, what Jason mentioned about roadmaps. Renewable energy, unlike fossil fuels, depends performance on like climatic conditions, geographical conditions, and it's very important to have these roadmaps for different countries, like which technology is more applicable and to which applications, and especially new technologies like hydrogen. I recently posted in the chat our call for papers we are doing with ADB, and we would like to discover the role of, let's say, of hydrogen, especially green hydrogen for countries, how it can help, especially that many countries now started to implement national hydrogen strategies, which is very exciting. And we see huge improvement in investments in hydrogen, especially that cost of green hydrogen is forecasted to be reducing significantly. Thank you very much.
Okay, thanks very much. I think we're out of time, but I think it's been very fruitful and detailed discussion. So please join me in thanking the presenters, and now let me close the session. Back to you, Keiko-san.
Thank you very much, Peter. Thank you very much for the very interactive, fruitful, insightful presentation, panel discussion. Next, we would like to move to the second session. In this session, we will discuss transition pathway methodology and KPI in Asia. I would like to introduce the moderator, John Bain, Vice Chair of Research and Senior Research Fellow at ADBI. He joined ADBI as a research fellow in March 2019. He has over 20 years of experience as an economist in public and private sectors. In his current role, he co-heads ADBI's research department, leading research work streams on macroeconomics, finance, and infrastructure. He has published over 30 articles in the peer-reviewed journals in economics and finance, co-authored or co-edited several ADBI books. He's also co-managing editor of ADBI Working Paper Series. He holds PhD in economics from Brown University. John, the floor is yours.
Thank you very much, Keiko, for the introduction. It's a pleasure to moderate this session today. And I think this session builds nicely on the first session that we had. As Keiko-san has mentioned, this will focus on transition pathway methodologies and KPIs in Asia. So the main focus will be on issues around credibility and putting in place practical, workable transition plans. Other issues to be focused on will include cooperation between the public and private sectors in these objectives, and also how to address the issue of hard-to-abate sectors and what can be done as regards their transition methodologies and strategies. So for this session, we have four speakers. I will briefly introduce the speakers now. I think we're a bit behind time, so I'll go relatively quickly through this. So the first speaker is Priyanta Wijetunga, who is Chief of Energy Sector Group Sustainable Development and Climate Change Department of the ADB. Second speaker will be Kensuke Nishiji, who is Managing Director and Deputy Head of Sustainable Business Division, MUFG Bank Limited. Speaker number 3 will be Masita Kristalin, who is Special Advisor to the Minister of Finance, Indonesia. And finally, last but not least, of course, we have the fourth speaker, who is Satoshi Ikeda, who is the Chief Sustainable Officer of the Financial Services Agency, Japan. Now, each speaker will have 5 minutes to make their intervention. I hope that they will be able to stick to the 5 minutes, and that will allow us to have some time for discussion and Q&A at the end. So please, Priyanta, may I ask you to go ahead for 5 minutes? Thank you very much.
Thank you. Thank you very much for this quick and kind introduction. I'll take you through quickly now that we had the my colleague, delivering the keynote speech, mostly focused on energy transition mechanism, specifically, implemented in Indonesia, Philippines, and Vietnam. I will try to bring you a larger, broader perspective of energy transition financing we pursue in ADB, so that you can get a flavor of what we can do in addition to ETM, particularly in other countries. If you look at the overall energy policy, I start off with this because that's very important, because when it comes to energy transition financing, as you can see, the energy policy is based on 5 principles. If you carefully read these 5 principles, you will see energy transition is more or less financing, cuts across all these 5 areas, 5 principles. One of our key objectives is, of course, to provide, energies, to our DMCs and ensure that we have a prosperous and inclusive Asia and the Pacific. And at the same time, of course, we have resilient energy future and so on and so forth. So if you look at all these 5 principles, energy transition financing cut across all these 5 principles. Then within this, our focus is going to be mostly on these, 7 blocks I have, at the bottom of the slide. Renewable energy, and then energy efficiency, and then decarbonization with as far as existing facilities are concerned, then resilient financing, and then at the same time we have to look at innovative technologies and so on, and of course at the same time things like phasing out of other, not just coal but other fossil fuel subsidies and so on. These are the areas where we are focusing on. If you look at specifically the relevant provisions in the policy, I quote 3 different provisions, mainly dealing with oil, coal, and gas. And if you look at the oil-related provisions, you can see that we have restricted oil-related investments to a minimum. Only downstream oil will be supported, particularly if you look at energy solutions in remote islands and so on, where obviously you cannot avoid oil-based fire generation. We will go into it, but then there are other conditions which needs to be satisfied, particularly on technical, economic, and financial viability side. And then, of course, it should be part and parcel of overall plan for decarbonization in these countries. And if you look at, in case of coal-fired power plants, obviously we have not been investing in coal-fired power plants, but we still allow coal-related investments like what David was talking about, where you have decommissioning of coal power plants involved, and that's where we would be investing money on. On top of that, of course, we still have within the policy allowances to provisions to support coal-fired power plants as long as there is no extended lifetime and reduction in reduction in emissions, GHG emissions. So these are areas where we allow into investments in fossil fuels. And when it comes to gas, again, the same story, very limited support for gas related investments as long as it's really, really necessary for energy access viewpoint, and it's you don't have any other alternatives to provide the same energy services, then we allow investments in gas infrastructure. So those are very important 3 provisions we find in the energy policy, where we try to restrict as much as possible investments in fossil fuels. And if you look at possible interventions, I don't have to, repeat this. Obviously, ETM is one of them. And so concentrate on accelerated decommissioning of existing coal fleet and accompanying development of renewable energy. As David quite rightly said, they are basically going in parallel in energy transition mechanism. Then currently, of course, as I said, focused on Indonesia, Philippines, and Vietnam. Then at the same time, in some other countries, you may like to look at things like improved generation dispatch regimes. You may not commit yourself to accelerate decommissioning of coal power plants, which is very important, of course, because we have a huge, fleet of coal power. But then next, improved generation dispatch also can bring in a lot of benefits, and that can be supported. And Then accelerated deployment of, I don't have to go into that, with preferential dispatch, increasing flexibility of fossil fuel power plants will allow more and more renewables to come. Then, of course, just transition. These are areas where we would like to intervene investments in. So as far as sovereign financing is concerned, main task of sovereign financing is to create an enabling environment for such investments, and particularly private sector investment. Then reach out to low-cost financing, like what David was talking about, the donors, the philanthropists, and try to bring in adequate funding for coal decommissioning, accelerated decommissioning, or increased renewable energy investments, and so on. Then, of course, sovereign financing has another major role in terms of just transition-related investments, capacity building, retraining, re-education, financing the safety net. These are all important and probably taken up by sovereign financing. Then, of course, we have the ability to leverage co-financing from other sources like co-financiers, other development partners, and so on. When it comes to private sector finance, that's another window we have. We obviously use the investments related to decommissioning of fossil fuel power plants. That Kitty can finance that. And obviously, at the same time, clean energy investments, again, leveraging co-financing and commercial financing. These are areas where we can intervene in terms of financing. So with that, I will stop here and I will take up any questions during the panel discussion. Thank you. Thank you very much.
Excellent. Thank you very much for a concise and informative presentation, Priyantha. So I would now like to move swiftly on to the next presenter, who is Kensuke Nishiji. Please go ahead.
Thank you. On behalf of MUFG and the members of the Asia Transition Finance Study Group, I'd like to express our gratitude to the organizers for giving me this opportunity to explain our recent progress as a study group. Yeah, the Asia Transition Finance Study Group was launched last year as a private-led initiative by financial institutions aiming at promoting transition finance in Asia. Maybe the slide, please. Go to the page 2 of the slide. Yes, this one. Thank you. And we have so far organized 6 official meetings and 4 learning sessions with 30+ members. Through these activities, we have deepened our understanding on transition finance and identified major challenges in Asia. To tackle the challenges, there are 2 key outputs which we are preparing at the study group. One is to establish a practical guidelines for financial institutions, and the other is to make recommendations to policymakers and governments to facilitate transition finance. As an interim outcome, we have issued the interim report in April and are currently drafting the final report to be published in September. Next slide, please. Yeah, this slide summarizes the goal of the study group. Numerous initiatives or guidance related to transition finance are currently underway all over the world. For instance, we have ICMA handbook that has been referred to in many cases as a de facto global standard, pathways for decarbonization established by various organizations, as well as taxonomies in some countries. And when financing transition activities, it is necessary to check against these frameworks or guidance to see if the transition plans align to them. However, it is not that simple for financial institutions to consider which guidelines they should refer to, especially when the borrower is in emerging economies, and how to conduct due diligence in accordance with them. Therefore, our study group aims at filling this gap, focusing on how to provide transition finance in reality by creating practical guidelines for financial institutions which supplement the existing global frameworks. Next slide, please. The left of this page shows the guidelines to be formulated by this study group. We would like to highlight that our guidelines only show the way of thinking and provide the framework and type of information necessary for evaluation. Separate from the guidelines, we request a third party to create a list of transition technologies so that lenders can refer to it even if technology roadmap is in a country is not in place. Evaluating along the guidelines with the technology list as a reference, financial institutions will be able to make their own decisions whether to provide transition finance. In addition, we aim to request support from governments and other stakeholders, mainly in 3 areas. First is to have sectoral and country level pathways and technology roadmaps that serve as reference points for financial institutions. And second is to consider just and orderly transition to strike a balance between decarbonization and social stability. Third is to provide incentives and financial support to promote transition in each country. Yeah, so that is the overview of what we are doing at the study group. Yeah, thank you very much.
Thank you very much, Nishiji-san, for this presentation. I would like to now move to the next presenter, who is Masita Kristalin. Please go ahead for 5 minutes. Thank you.
Thank you. Can I have my slide up, please? Thank you for the opportunity. Next slide. I would like to share a little bit experience from Indonesia. As you all may know that Adbi and Indonesia and several other countries has announced a partnership on working on the energy transition mechanism during the COP26 in Glasgow. This is joined by Indonesia and Philippines as the key partners, and 25 million grants was announced by the Japan Ministry of Finance as the first seed financing for the mechanism. And the partnership has also been endorsed by senior cabinet level official from Denmark, the UK, the US, as well as leading global financial institution and philanthropists. Next. After that discussion in Glasgow, we have go through a lot of the details. So basically, we would like to make the energy transition mechanism into a just and affordable transition, of course. Otherwise, it has to be affordable, both in fiscal and a corporate level for the SOE, electricity SOE, which is PLN. So we would like to have a financing method for achieving the optimum energy target mix, which we would like to achieve 23% of renewable energy by 2025. We also have a specific or detailed roadmap on achieving the NDC in all sectors, of course, including electricity by 2030, and to achieve net zero by 2060 or even faster than that. Reduction of greenhouse gas emission to achieve Indonesia NDC and NZA on the electricity sector, and also shortening the economic life of some of our coal power plant. The constraint is that we are currently start to make more efficient fiscal spending, right? Because after the pandemic, there's a lot of priority of the government as well. We would like the transition to be just, not only for the environment, but also for social workers and also society. And also we actually have an oversupply of electricity in the Java and Bali of almost 40%. So if we only add the renewable energy side without early decommissioning the coal power plant, then we will exacerbate our excess supply problem in Indonesia, which has fiscal implication and has also environment implication because we cannot reduce the carbon emission. Next. I just would like to show you that we have a roadmap until 2060 to achieve net zero. Of course, this has a combination of many things, including using CCU, CCUS, which is still expensive now, but we believe we're hopeful that the technology development between now and then will make the global society can see more affordable technology for this so that country can achieve the net zero. Next. This is the financing scheme alternative that we work on with the Adbi. So basically we have the left-hand side is the carbon reduction fund. This is the early decommissioning. We have several types of assets. We have the one under PLN book and also the one outside of PLN books and several smaller plants. So the oversupply condition happens on these three types of assets. And of course, because the asset type is different and ownership is different, the method to early decommissioning this site has also been different. On the right-hand side is the Clean Energy Fund. So this is to build the renewable energy. At the onset of this project, the suggestion was to link both the carbon reduction fund and also the clean energy fund, but we're creating it in such a way that it will not exacerbate Indonesia's excess supply of electricity. So in the first stage, where we still have oversupply in the Java and Bali, we will early decommission first. So we're going to work on the left-hand side first until the oversupply becomes affordable, thin. And then after that, we're going to start linking between the left-hand side and the right-hand side in the future project. Next. On July 14, this month, we are going to, next slide, please. On this July 14, we are going to launch Indonesia Country Platform. So Indonesia will create a country platform with advisory and steering board of all the ministries and members from relevant Eselon 1 unit. We will appoint one of our SOE, in this case PT SMI, as the country platform manager. And this country platform can have both sides of the fund, left-hand side and right-hand side, like I mentioned. It can work with different type of asset. It can create different SPV in order to early decommission or building the renewable energy. But the role is not as investor. The role of the country platform manager is for making sure that the financial viability of projects can crowd in private sector investment. So there will be de-risking facilities, there will be commercial and non-commercial loan, low-cost refinancing, technical assistance, etc. These box on the left-hand side, number 4, are still under discussion, but basically what we want to have is to have some kind of de-risking and also catalytic financing role. Under the country platform manager, you can work with different source of fund. Of course, part of it should be from the concessional government and also philanthropists, MDBs, including ADB, World Bank. But a big part, we're expecting it to come from commercial if we already improve the financial viability through the catalytic financing role of the country platform manager. It can work on the PLN project, IPP project, and pipeline project, and it create, as I mentioned, different SPV just to make the format more flexible. I think that's all that I can share today.
Thank you very much, Ms. Kristallen. You've presented a very comprehensive set of material in such a short space of time, so thank you for that. Moving to the last speaker of this session, before we move to the Q&A round, will be Mr. Satoshi Ikeda. Please go ahead, Ikeda-san.
Oh, thank you. Thank you for that introduction. I'm going to present the transition finance framework developed by Japanese government. And actually, the government of Japan has been making huge efforts to develop such a framework within Japan, but also certain implication for the Asia and Pacific as a whole. And in presenting this framework, I actually remember that I made a certain remark 3 years ago at the PRI hosted Sustainable Finance Policy seminar in Paris. And at the time I said that the taxonomy, especially EU taxonomy, would become a kind of Darth Vader in sustainable finance. Meaning that, well, certainly the effort to develop taxonomies comes from the good intention, but it can choke off the necessary financing to particularly to how to abate sectors who need most among many sectors the financing for transition. And actually, I heard that from Jason earlier at the previous session, that there is a certain brown stigma. And so the transition finance is to break off such stigma with a certain backing of science and technology. And so I would say that from my perspective, the transition finance is a kind of Luke Walker in sustainable finance to save the galaxy, I would say. And so with that background, I would like to introduce some of the features of the Japan transition finance framework. And first of all, we have developed the guidelines on climate transition finance, and also the sector roadmaps, which are based upon certain technological information and a certain amount of emissions related data. And so with those guidelines and roadmaps, corporates are expected to develop a transition plan through which they commit to transition their business activities towards net zero. And financial institutions will assess the credibility of the transition plan and to finance those corporates accordingly. And between them, certain external reviewers have a role to play to validate the credibility of the transition plan. Well, guidelines are built upon the 4 key points. Then there should be certain strategy and governance for managing the transition. Well, companies need to address the environmental materiality issues in the transition plan, and their transition plan must be backed by certain science-based knowledge, and also there must be certain transparency for the transition plan. And sector roadmaps, that shows that what kind of technology should be adopted by a company in a certain sector in a certain time frame. And well, we have to face the inconvenient truth that well, all the technology available right now will not enable us to achieve net zero. We need new technologies. And so by clarifying what kind of technology will be needed in a certain time sequence, not only enabling a finance to hard-to-abate sectors, but we also like to encourage the financing to technologies which include a certain carbon removable technology, which will be quite fundamentally necessary to achieve net zero in the mid-century. And so our approach can be characterized as dynamic and flexible and interactive. Dynamic meaning that, well, we need a dynamic assessment of the trajectory of the corporates towards net zero, and not point in time assessment of the company. So we need a certain forward-looking feature in our assessment in the transitioning. So while in our framework, we believe that we can achieve that element. Also certain flexibility. Well, in a taxonomy, well, it's a kind of binary system. So certain granularity is lost in taxonomies. So there is going to be a certain green, non-green, or maybe certain transition category. But maybe there is a certain activity which very close to green, but categorized as non-green. Because our framework is built upon the certain assessment of technology adoption and also the emission data, we can ensure certain granularity in our framework. And the last element is that interactive. Well, because this is an evolving thing, and I have to say that the transition finance development is still an iterative process. So we need an interaction between corporates and the financial institutions, the external viewers, and other stakeholders. And we are very much accommodated to that kind of development in transition finance in the future. And well, one of the important things is that the ISSB proposes climate-related disclosure standard right now. And it includes the requirement for the disclosure of scope 1, 2, 3 emissions. And the US does the same kind of proposal, and the actually EU, this climate sustainability related disclosure standards include the requirement for disclosure of scope 1, 2, 3 emissions. So emission data will be a kind of global baseline for future climate finance. And so we would like to build upon that, but at the same time, in certain emerging markets, there may certain difficulties in disclosing scope 1, 2, 3 emissions in the future. So if that is the case, I believe that the technology information-based roadmaps can complement the emission data-based transition finance. And I believe that the Japanese version of the transition sector roadmap shows a certain model for emerging markets in such cases. So I finish here. Thank you.
Okay, thank you very much, Ikeda-san. Very useful and interesting insights. We now have around 10 minutes for the Q&A round, so our discussion round. There are no questions in the Q&A box. So what I would propose is that I will ask one question to each panelist, and then if you can respond in 2 minutes or so, that would be appreciated, and then we can see where we are. So first of all, the question to Priyantha. So I think that we've learned from the discussion that credibility in transition pathways is going to be very important, and is very important. So my question to you is that, is there any room for further coordination and cooperation between public and private sectors in the promotion of transition finance in Asia?
Yes, thank you very much. That's a very valid and a pertinent question. One thing, of course, to improve this credibility and enhancing credibility in this transition pathway. One thing ADB can work with the governments to identify, particularly the risk associated with transition. As you know, there are various risks, and raise awareness and build capacity and provide training. That's one thing what we can do. And also the other is, as I indicated in my presentation, we can help mobilize international resources to support creation of new markets. And with that, obviously, you basically improve the credibility. And we can support countries in nationally determined contributions and long-term strategies and policy support, including setup of things like green bonds. And then, of course, we can support national development banks to improve the credibility within the institutions in these countries, local institutions, and the financial intermediaries to develop financing solutions for not just things like energy transition mechanism, but also things like energy efficiency, as well as renewable and other clean energy technologies, including de-risking some of the investments, particularly entailing investments in innovative and new technologies. So these are some of the things what we can do to enhance the credibility of transition pathway in Asia. Thank you.
Okay, thank you very much. My next question goes to Nishiji-san. So you talked a little bit about the Asia Transition Finance Study Group. And given that regional and country-specific pathways or the roadmaps are still in a very much developmental stage, in some countries in Asia at least, what kind of solution does the Asia Transition Finance Study Group aim to propose?
Okay. Oh, sorry. Yeah. As you mentioned, yeah, our solution is to create practical guidelines to bridge the gap between the global framework and the, practical, situations of each bank. So what we're doing is to analyze the global frameworks and find what are missing from the practical, viewpoint. And we identified several items like, for example, economic handbooks doesn't say, which, technology we can, lend against and or, which threshold we should take. And so that kind of practical aspects we need to fill the gap. So, but the problem is that, the final decision should be made by each financial institutions. So our study group is just providing the guidelines for the users and how can I say, bridge the gap between those differences. Maybe this is a too vague situation, but this will be incorporated in the final report we'll be publishing in September.
Okay, thank you very much. To Ms. Kristallen, I would like to ask you about the ETM partnership, and if you could share your views on how this could enhance the credibility of transition pathway in Asia.
Yeah, I think this partnership is really good, right? But any reform, or in this case, the country platform, has to be country owned and country managed. Otherwise, it's really hard because the country has to take ownership and responsibility in coordinating all of these parties, right? If we do it, if you imagine we do it the other way around, for example, we're having an outside organization such as Adbi imposing something on countries that doesn't have ownership on the project, it will be very hard to continue, which is why our partnership with Adbi right now, I think, is really positive because the government has the ownership and the Adbi is also supporting in all the avenue that we're trying to do. The other thing is that also the world is changing, right? First, we in the G20 Indonesia presidency, we put the definition for transition finance, and hopefully we will have a transition activities taxonomy, right? Because if we're working, for example, like an energy transition project in Indonesia, you're working only on the left-hand side now on the first stage. Then in the old taxonomy of green taxonomy, this may be categorized as non-green. So it cannot be financed by this financial, for example, MUFG probably cannot finance this type of activities if you don't look at the overall reform strategy, right? Well, coordinating with global organization, Adbi in our case, is also good to give credibility for government plan to do all of these things, and to help our pathway into convincing other people and also preparing on the projects as well. Indonesia is doing on the two direction. Yeah, first we're doing top down, so the setup of the country platform and regulation and the fiscal support, but also we're working on the project level basis. So we already have a project list that's ready to be worked on this year and also next year, of course, until 2030. So I think that's how the partnership can work if country has ownership.
Okay, thank you very much. To Ikeda-san, I would like to ask you about the hard-to-abate sectors, and if you could share your views on some of the specific initiatives in place and some of the challenges that this sector faces in its transition.
Certainly. Well, for example, the steel sector. Well, there's a certain idea of hydrogen based steel making, but it's certainly still under development right now. So how the steel sector can position themselves towards net zero is a very difficult challenge. So they have to make a certain efforts to develop the hydrogen-based steel making, but at the same time, they need to make also significant efforts to streamline and also improve the efficiency of the current steel making. So they need to address both challenges at the same time. So and design their transition pathway toward net zero, ensuring certain consistency with the credible pathway toward net zero. So the solution to that challenge is very difficult. So it involves the consideration for certain technological development and also the viability of securing a certain financing, all those things. And so, if we commit to resolving the challenges for net zero together, I think we can work out the credible solution. So that's what I think our transition finance framework is hoping to achieve. And so I think many similar challenges are faced by other hard-to-abate sectors. So through our framework, we really hope that the challenge will be resolved with a collaborative way.
Okay, thank you very much, Ikeda-san, for that response. We've basically run out of time, but I don't see any questions in the Q&A box. So I have one more question from my side. And if I could ask each panelist to just say, a couple of words in response to that. So the question is, do you feel that policymakers or regulators can do anything further to incentivize the promotion of credible and practical transition plans for any sector, not just hard-to-abate sectors? So is there anything that policymakers can really do to provide an incentive for this transition path beyond what's already in place? So first of all, to Priyantha, please go ahead.
Yeah, thank you very much, John. And as far as our own DMCs are concerned, developing member countries are concerned, I think they are quite convinced that we need to do it, and they have been doing quite a lot of things. But still, I think a lot of work to do, particularly on improving the regulatory or creating the enabling environment for these investments, not just retiring existing assets, fossil fuel assets, but also on the clean energy side. I think that a lot of work needs to be done. We have a lot of work to do from developing financing institutions. Thank you.
Excellent. Thank you very much. Nishiji-san, please go ahead.
Yeah, thank you. Incentives from policymakers and regulators are essential, of course, and even if all necessary guidelines are established and the financial institutions are ready to provide financing, but companies would still hesitate to make capital investment to transform their business if they see any uncertainty after transition. And it will eventually make fundraising difficult under such uncertain circumstances. So policymakers or regulators should introduce a program which enhances predictability of business after transition. Such policy support shall be provided consistently over a long term to attract investment and financing. That's a key point, I think. And they can be in the form of subsidized pricing mechanisms such as feed-in tariff or long-term offtake arrangement with public corporation or appropriate carbon pricing.
Thank you very much. Ms. Kristallen, same to you, please.
Thank you. So I think the two major things is creating an enabling environment for this to happen, yeah. And number two is the catalytic role of the fiscal has to be enhanced. On the first part, in enabling, I second all of the previous speakers. I would like to emphasize that we need a transition taxonomy, not just a green taxonomy. Government, of course, can create different instruments, de-risking and also catalytic role instrument. And also on the financing side, creating regulated but quite open and efficient carbon market in order to support part of this transition from the private sector perspective.
Thank you very much. And finally, Ikeda-san, please go ahead.
Right. Oh, okay. Well, from the eye of a prudential regulator like us, what is most important is the financial institution would address the physical risks and transient risks associated with climate change, and making transition efforts, well, encouraging transition efforts by borrower companies or investee companies. That will reduce the physical risk and transient risks faced by financial institutions. That kind of mindset is very important because that will create a certain incentive for financial institutions to engage with client companies for transitioning activities. So actually the Financial Services Agency is going to finalize our own supervisory expectation of climate change. And it certainly included that kind of element. So from the prudential regulator, that kind of incentive mechanism is very much important in backing the transition finance activities.
Thank you very much, Ikeda-san, and thank you to all the speakers in this session. I think we had a lot of information. A lot has been learned. It will take some time to absorb all of the information that we have heard, I think. But there are clearly challenges ahead in terms of, putting together practical plans that can actually achieve the objectives that are set. The issue of taxonomy was mentioned by Ms. Kristallen in her last response, and that will be the next session that will be part of this event. So we look forward to that. And I now hand the floor back to Keiko-san to carry us through the rest of the seminar. So thank you very much to all.
Thank you very much for the insightful panel, John-san. And I'll move on to the third session today. Well, I would like to introduce the moderator, Mr. Calvin Tan, Managing Director, Head of Sustainable Finance and Investment SN for HSBC. He was appointed to this role in September 2021. In this role, he oversees the provision of sustainability-linked finance, the development of innovative climate solutions, and the lead cross-business and cross-market collaboration in sales enablement and risk management. Calvin will also work closely with other ASEAN CEOs to help them drive the conversation with external stakeholders. Prior to joining HSBC Singapore in 2009, he started his career with Citibank and had worked at JP Morgan and Societe Generale. Mr. Tan, the floor is yours. And then in terms of the Matthew Chan, we'll see, he'll show up. So, but probably please introduce him briefly.
Well, thank you very much, Keiko-san, and very good morning to everybody. Thank you for dialing in this third session. And today in this session in particular, we're discussing about transition finance taxonomy in Asia. And I think in the previous sessions, there were quite a lot of discussions on taxonomy already. So before I start, perhaps I would like to introduce the panel of speakers. As Keiko-san said, we have actually lined up 3 very distinguished panel of speakers. Let me introduce them first. First of all, ladies first, we have Helena Fang. Helena Fang actually heads Sustainable Investments Asia Pacific for FTSE Russells. She is actually head of Sustainable Investment Asia Pacific. She's responsible for FTSE Russell's sustainable investment indices, data and analytics solutions across the region. Prior to joining FTSE Russell's, she actually has a lot of experience in the ESG space, working in ESG integration, equity analysts, and advising in philanthropy for family offices, asset management, and institutional clients. Next, we have Mr. Eugene Goen. Eugene is actually from Ernst & Young, and he actually represents Ernst & Young Asia Pacific Financial Services Regulatory Advisor, where he advises multinational financial services firms, industry associations, and regulators on strategic regulatory and compliance issues, including sustainable finance. Prior to joining EY, Eugene actually works in Hong Kong Securities Futures Commission and also in the Australian Securities and Investments Commission. I'm not too sure whether we have Matthew here with us. I think he has joined, but he could have some. Matthew, are you here? Yeah, Matthew is joining.
Oh, good.
Yeah, so let me introduce Matthew first before she joins. So Matthew is the Executive Director and Sustainability and ESG Engagement for Asia Pacific for JP Morgan. Matthew has actually just joined JP Morgan in 2022, where he's responsible for shaping and driving JP Morgan sustainable agenda. Prior to joining JP Morgan, Matthew was actually led Asia Securities Industry and Financial Markets Association for Public Policies and Sustainable Finance divisions. He has also worked in various multinational companies throughout his 25 years of career, including Thomson Reuters, PepsiCo, Cadbury, Schweppes. So, I think in the interest of time, let us just begin first. So we're going to do a different tack for this session. We're not going to have any presentations, but we're going to make it as interactive as possible. Just a reminder, if any of you, anybody has any particular questions, please feed that back into the Q&A sessions, and we'll try and cover your questions as much as possible. Taxonomy, I mean, it's something that we all talk about, in terms of transition financing. It can be quite elusive. I like the idea that the previous speaker, Ikeda-san, says that, the EU taxonomy is like Darth Vader, and that's a very funny analogy, I think, maybe appropriate, but it's something that's quite elusive now, right? But it's important. So if I may start by asking the question to the panelists here, what is the current status of the development of taxonomy that you see, in your field, in particular in Asia, right? And maybe you can explain to us from your perspective, from an investor, from a lenders, and also from a regulatory point of view. Helena, if you would like to start the session. Thank you.
Thank you. I'm very happy to be here and to participate in the conversation. I can draw maybe on a few things that have been said already. And I think Ms. Crystalline said in the previous session that we need transition taxonomies as much as we need green taxonomies. So I'll certainly echo that. With regards to the EU taxonomy, it's given a really interesting precedent for the development of taxonomies in Asia in terms of enabling policymakers here to pick up on some of the core elements that are useful, and also, I think, to learn from maybe some of the parts of the EU taxonomy that have introduced a lot of complexity, and that may be something that for certainly the developing economies here are harder to implement. But certainly I think we've seen very active development of taxonomies in Asia. And I think one of the things that was said in the opening keynote from the speaker from Allianz was the huge amount of investment that's needed here in the Asian region in order to meet many of the climate objectives that economies and jurisdictions have in Asia. So certainly that element of needing to finance the solutions that are required to meet those goals has led to a lot of focus on frameworks and taxonomies. Look, we could call out a couple of these. Certainly the ASEAN taxonomy has been a very interesting development in terms of bringing together a number of different taxonomies that have developed across the region. We've also seen Singapore introduce the concept of the red, amber, green framework and the regulatory technical screening criteria that apply to that. In particular, I would say the amber category, which directly focuses on transition. So that's another very interesting development here. I think Ikeda-san also mentioned the basic guidelines on climate transition finance that the Japanese regulators have introduced, which is not exactly in itself a taxonomy, but certainly a very interesting approach to understanding that there are going to be companies that need financing, especially in the hard-to-abate sectors, and that we really need to incentivize both transition planning towards decarbonization in line with climate objectives, but also the flow of capital towards green and sustainable solutions. So I'll pass over to Matt and to Eugene to add to that, but certainly a lot of focus here on taxonomy, and also I think some very interesting innovations as well from a regulatory perspective.
Thank you, Elena. Matt, any comments, further comments?
Yeah, I know we're going to talk a little bit in terms of putting taxonomies into perspective, but I think certainly there has been a proliferation of taxonomies, and that in itself is particularly challenging for financial institutions. I will definitely take the quote back about Darth Vader back to my colleagues, because in some ways there is a kernel of truth in that it has, with the best of intentions, it's become a little bit challenging. I think it's really important that we put taxonomies into perspective. They can provide a very sound way of signaling to investors and stakeholders in their decision making what kinds of activities need to be or are aligned with net zero, for example, but on their own they're not sufficient. It's really important that they are backed up with incentives and penalties in the real economy. I think we heard from the other speakers, Ikeda-san, of course, talked about sectoral roadmaps, and we heard from the Indonesian finance ministry in terms of their energy transition mechanism. So I think that's really important, that we actually think about taxonomy in context. They don't in themselves incentivize capital flows. You really need to incentivize things in the real economy. And so what they can do is guide, but they won't in themselves direct capital to where it's needed.
Thank you. Maybe over to Eugene. Eugene, in your role, in terms of providing advisory work for the regulators and all that, what do you see in terms of the development of taxonomies, in this part of the region, in ASEAN and Asia Pacific in general? Yeah.
Sure. I guess we've been through a period of sort of rapid development, with Darth Vader, for want of a better word, looming over them all, or you could say the one ring to rule them all, one ring to bind them. What we're looking for now, I think, essentially, is a degree of convergence between taxonomies. I mean, the EU model has fundamentally been probably the most internationally influential one. There's been a search, I think, within Asia for adjustment of that for local circumstances. And, some in particular are feeling through, are all of these principles applicable, or are they a hamper to usability and applicability effectively? I'd say the EU taxonomy is remarkable for its breadth, its sophistication, and its stringency. It is not necessarily the most workable and implementable of taxonomies. So there's a tension between sophistication and simplicity and usability, and a taxonomy at the end of the day has to be usable. So I think what we're going to see now is, an emphasis on three things. One, convergence or harmonization, but that's probably a Wizard of Oz style goal that will never be achieved. Interoperability is critical because, finance does not sit within a single jurisdiction. It will usually be cross-jurisdictional. And the question of how you apply potentially multiple taxonomies to a single task to facilitate that flow of international finance that Matt said is essential. I think the second thing is, the needs of the end user effectively. Corporates and financial institutions are going to have to apply these taxonomies, and they have to, one, understand it, and two, it has to be applicable by them. So again, there's a trade-off between complexity and comprehensiveness, or sophistication or level of ambition, and how usable it is. Secondly, there are interdependencies here. We need corporate disclosures, and we need data and availability. We also need a large degree of guidance on interpretation, because taxonomies are complicated instruments. It will not always be obvious to the industry exactly what they mean in all instances. And there'll be need to be some iterative feedback between industry and the regulators, or the taxonomy progenitors, whoever they are, to assist industry with that. Lastly, capacity building. I think, taxonomies can be, particularly ones of the EU nature, quite sophisticated. They require, reporting structures within entities, both corporate and FIs. They need skills as to audit technology, and interpretive skills as well. So there needs to be time for institutions and corporates to get used to this, particularly smaller institutions and corporates that don't necessarily have the sophistication of some of the entities, that are operating in this field. So that all needs to come together, and I think that will happen over the next 2 to 3 years, but there's a lot of work to be done to get there.
Thank you. That's very insightful, and as you say, we have to balance the complexity part of it, and setting the gold standards versus what's practical, on the ground here in Asia Pacific, right? So I guess the question is that, when we are developing an Asian taxonomy, and even narrowing down to just this region in ASEAN specifically, how do you think, that we can bridge the gap between demands, from what EU and the West are looking at versus what the reality on the ground is in terms of the practical aspects of things, given the fact that, even in the ASEAN region alone, the countries are so different, in terms of its level of development, and their priorities, in terms of decarbonization. Maybe I can just stick with you, Eugene. Any thoughts on that? Because on this call, there's a lot of financial institutions here. That sometimes international lenders and asset owners and investors have to adopt to certain in global standards versus the taxonomies that will be rolled out here in Asia. But, yeah.
Sure. Look, I think dialogue between industry and the taxonomy progenitors is essential, and that needs to be two-way. Now, I think those issuing taxonomies in Asia have been very transparent, which is to their credit. That really needs to continue. And there also needs to be a dialogue between the various jurisdictions in Asia as well, which beyond the common ground taxonomy under the IPSF, the EU and China, we don't really see at the moment. I mean, other entities and jurisdictions are represented in that forum, but there needs to be more dialogue, particularly between, the APAC jurisdictions and the EU, I think, and maybe in time the Americas as well, if America gets around to issuing a taxonomy. Within entities themselves, I think there's a need for them to talk among themselves. We were recently talking to one global financial institution on behalf of an industry association, and I was surprised, how difficult it had been to get up to a very early stage of application of the EU taxonomy. Really, they just alignment is the wrong word. They determined the eligibility of their counterparties with the industry classifications under the EU taxonomy. That had taken quite some period of time, particularly because disclosure regulations were not available, so they're relying on proxies and assumptions. And a suggestion that they made, which I thought was excellent, was a need for a sort of industry-wide dry run or economy dry run of a taxonomy across an economy, which I thought was interesting, potentially involving asset managers, corporates, and financial institutions that would be intermediating finance. I think that's a very interesting idea. And look, there are still some efforts within industry, even front-running taxonomies. If you look at some of the internal transition playbooks that some financial institutions have issued, one from a bank that's green and blue that I won't name, but I think you can guess who I'm talking about, is quite sophisticated. And other institutions are achieving their own sort of internal taxonomies, for want of a better word, that are sort of front-running the industry taxonomies in certain senses. And that's an interesting approach as well, I think. So there's a few things that are going on and a little bit more that needs to be done, I think.
Thank you. Maybe if I can channel the next question to Helena. Helena, from your role, in your current role and your previous roles, looking at it more from an investor and asset management point of view, in terms of taxonomies, right, and basically the alignment of taxonomies, across, the West and Asia, how important it is, in particular, you see now there's a lot of issues in terms of greenwashing that has also come up, right, on that front, and how do you see, the ability of taxonomy to help provide some more transparency to that, and perhaps preventing, the risk of greenwashing?
Sure. Well, look, I think greenwashing in general, as it regards to sustainability, is something that's on the front of everybody's mind, both investors and also regulators. And certainly taxonomies as instruments are intended to give confidence, I think, that will then lead to the outcomes that are necessary in terms of directing capital towards specific activities. So I think from that perspective, there should be a tool that helps to circumvent those concerns. At the same time, I would also say that having sufficiently strong standards in place, and also thinking through in terms of disclosures, how those are verified over a period of time as institutions become used to complying with these kind of requirements, but also build up to being able to implement the disclosures that are needed is going to be important, particularly when we talk about transition as well, because as I think Ikeda-san pointed out in the last panel, there are two elements to transition taxonomies. One is the activity level, but the other is entity level. And if you think about how we assess transition at the entity level, it's really about looking at what the companies are doing themselves to put in place, climate transition strategies and the governance around that, business model, environmental materiality, and so on, and then the reporting of that. And then that leads us to a conversation on verification. So this is something else that I think corporates and regulators and investors are going to have to tackle over a period of time. But yes, I mean, in some, I think all of those elements together are going to be important, but it is also, I think, key that we do tackle some of these more difficult areas. And I think going back to the conversation on the EU taxonomy, providing a model of some of the things that are both desirable and also more complex and harder to achieve around taxonomies. It was one of the things that I think was called out fairly early on was this idea that if you're not green, perhaps you're brown, but there's obviously a middle ground here that's very important, particularly from an Asia perspective, as we do have some very carbon intensive economies that are going to need to go through that transition process. So, I mean, how you report on and account for that and the standards that you put in place are also important. I think the other element that is interesting to call out here as well is the dispersion in terms of the way that taxonomies can be applied and interpreted. And I think the ASEAN Taxonomy Board here have made a very interesting effort in terms of looking at which countries are able to maybe fulfill some of the more complex screening criteria with the plus standard, and then looking at those that are going to be more along the sort of the principles-based line. So I think, again, it's really about drawing a balancing act between the ability to comply and also this is something of a journey that both issuers and regulators and financial institutions are going to have to get used to as we see taxonomies mature and develop. So certainly that greenwashing element, I think, is very important. At the same time, there are going to need to be standards in place that support that.
Absolutely, Helena. And if Matthew, I mean, if you would like to, share your views on this particular topic too, right? And in particular, there's a lot of talk interoperability. There is, I think we recognize that, in Asia in particular, given the scale of Asia and the economies and all, it's difficult to have one standard, but the whole purpose and the interoperability of this, how do you think that can happen, and how realistic do you think, that will pan out, going forward?
Thank you. I suppose we, just stepping back a little bit, I think we need to be very clear in terms of just some design principles. Mm-hmm. One, there's the context piece, which is making sure that the taxonomy supports regulation and policy context. Two, I think, and I think Helena just touched on it and covered that quite well, but it's really important that we think about the purpose of a taxonomy. And I think traditionally, perhaps in the EU, it's very much focused energy and effort and attention to green activities. But actually, I think the question is, how do we actually focus on the broader economy? So all those brown, or what we might, some taxonomies might call a brown activity, that's actually where in a region like Asia, with emerging markets, with different sectors on different trajectories, that's where we actually need to focus. So a taxonomy in our context, I think, needs to actually focus on the real economy, green and brown, and then focus effort in terms of, okay, what are those transition paths? The other thing I think is important is just clarity of purpose. I think one of the challenges is when almost the Christmas tree effect, everyone wants to hang a little piece on it. I think it's really important to be very clear about what you're trying to do with a particular taxonomy. I think when you add complexity and you start to build on, maybe social factors or environmental factors in addition to climate, that's when things become a little bit more ambiguous. I'd also point to, it seems like there's been a rule of 5. A lot of organizations have been very helpful in terms of providing lists of 5 things that should be taken into account, but I think some of them are important. The GFMA, of course, had a rule of 5. It was about kind of thinking about taxonomies in the sense of not just thinking about green bonds, or use of proceeds, thinking about at the entity level, being very clear in terms of objectives, needing to be science-based, needing to think from an interoperability point of view. There needs to be flexibility. So taxonomies generally need to be follow a general set of principles, and I think ASEAN, for example, is a great example of trying to think about that at a regional level, so that when we have underlying taxonomies at the jurisdictional level, there is some kind of guiding principles and definitions. I think it's also important that we do think about ease of use, because again, this also touches on the idea of lack of clarity of purpose. Also, if it's not easy to use, that's when these things become a compliance exercise. And we also need to think about users in terms of corporates, when they're thinking about their activities, and they could be large and small, they could be listed or unlisted. So we also have to think of the burden that large companies might be under, but also small companies, because if they are overwhelmed with trying to comply with these things or disclose against them, that's when it becomes a compliance exercise. And that's when there is also a risk of greenwashing, because people aren't kind of following or thinking about what the purpose of this is. I think the other, ICMA had a rule of 5. For them, it was about being very targeted. And in a way that was also emphasized by the BIS principles of 5, which also included something about one taxonomy, one purpose. And that goes back to clarity of purpose. On interoperability, there's a couple of dimensions to that. So it's not just about, giving clarity, which we also need as a financial institutions when we're dealing and traversing multiple jurisdictions, because of course, a transaction could be taking place. You could be headquartered in the UK, but the transaction is taking place in one jurisdiction in Asia and the issue is in another one. So there needs to be clarity and a way to kind of navigate that. And at the moment, that is a challenge when we have multiple taxonomies. But also you have to think in terms of time. What happens when an instrument is, or a transaction takes place, or something's resold? It might conform today in China, which has a commitment to 2060, but then it might be sold to another market. So we also need to think about the danger there, and there could be perceptions unwarranted in a way, or unjustified in terms of greenwashing, because it did meet the requirements for that particular jurisdiction at that particular time. But at the same time, when it's sold or unsold in a future market, then it might not conform. So that kind of flexibility needs to be inbuilt. So I think it is about interoperability. It's also about coordination, but it also goes back to just being very clear about or having very big focus on clarity of purpose.
Thank you, Matthew. Picking up on your point about how Europe is, the EU taxonomy is looking at it from an environmental point of view, and how in Asia the focus should be kind of slightly different. I think some of the previous speakers have mentioned this word quite often, which is just transitioning, right? The social inclusionness of transitioning, because in particular now as we speak, there's a lot of issues in terms of energy security and things like that. So when countries in Asia are looking at taxonomies, in particular transition taxonomy, how much of the social aspect of it you think is now being in consideration, from both the private and the public sector, in terms of use? Any thoughts, Matthew, Eugene, or Helena on this?
Maybe if I can start, and I'll be brief.
Yeah.
I think that is a challenge, and there's no easy answers to that, because we completely understand, and in our region, it's really important that we think about not just binary, not just transition, but we do need to think about transition, because obviously different sectors, different economies. And we also get completely the need to think about social concerns and social stability, energy stability. The challenge, of course, is trying to build these all into the one taxonomy. That's where we get to that complexity. And I think, and going back to interoperability, it's often been things like trying to accommodate things like do no significant harm in the EU taxonomy, that is the one thing, or that is one of the factors that makes interoperability very difficult, because do no significant harm in one jurisdiction, unlike climate factors or climate metrics, those kinds of social metrics are more values-based and more politically informed, and so they will be different in different economies. And so trying to build those into taxonomies is where things start. That's the first realm of where things start to get complicated, and that's one of the first areas where interoperability starts to break down.
Can I add on to that, that we have done some research on the EU taxonomy that indicates that adding in both the technical screening criteria, the minimum social safeguards that do no significant harm, makes it very hard to identify companies that can actually comply to the EU taxonomy across all of those parameters. Having said that, I think this concept of no significant harm is a very useful one to introduce, in as much as that it does support potentially also the concept of just transition. And in terms of making sure that the activities that are promoted and supported through taxonomies are also aligned with social outcomes as well. And I think in general, we see, and there have been a number of research reports attesting to the fact that the green economy activities are actually conducive to social outcomes and to better health and working conditions anyway. So, I mean, in that sense, I think there is a strong conceptual and evidenced alignment. The other thing I would say is we can interpret, perhaps in this part of the world, the concept of just transition on a broader basis and on an economic basis, actually, if we think about transition and what that means to a number of the economies here as well. So we should be thinking, I think, not only in terms of what just transition means from a sort of an employment perspective, but also what it means in terms of enabling economies here to also catch up to some of the developed markets as well. So I think it's another interesting way to think about what benefits taxonomies can bring to the societies that they operate in.
Yeah, absolutely. Eugene, your thoughts on that?
Look, I think a lot's already been said that's very valid. Look, I think the rationalization or the intersection of social and green it's there, it's inevitable. And, you know, I think it's just one of those issues of reconciling competing, and in some cases, as Helena pointed out, aligned social objectives. I think the cat's out of the bag to a degree because, again, returning to the Darth Vader metaphor, you know, with built-in DNSH and MSS, do no significant harm, minimum social safeguards, and a lot of jurisdictions have copied that idea already. So, you know, I mean, it's there, and, you know, I know Matt alluded to the BIS principles of sort of keep it simple, stupid, basically, of one taxonomy, one purpose. You know, I personally, you know, no offense to the BIS, I find that a bit intellectually purist, because it would be a very useful goal, but at one end of the day, you are going to be asked, well, if this is a labeling requirement effectively, which, returning to the basic principle of taxonomy, if it does have a substantial contribution to one environmental objective, what is its social impact going to be under a social taxonomy? So you either combine them or you separate them, but at one stage you're going to have to reconcile them. I think ultimately it's about making that principle workable. I honestly don't have a solution to that, because I think all the points that Helena and Matt have made about the workability of DNSH and MMSS are yet to be resolved. But, you know, human ingenuity being what it is, I think as we're forced to grapple with both social and environmental aspects of you know, things that society is now demanding that we consider in the direction of finance and provision of finance, we're going to have to resolve these. So I don't have an answer yet. I don't pretend to, but I think we will work our way through it. It may just take time. Data is a key issue, the data standards, the data availability. And look, in Asia, that's a particular problem. And I think there's a large degree, for not all social objectives, some I think like clean water or access to education, probably easier to define. Some do have an assumed political underpinning that assumes agreed political values. I'm not sure that's necessarily the case in Asia, given the diversity of political systems here. So, you know, there'll be some degree of debate around how to achieve that, I think.
Thank you. I'm just looking at the time, and I think we are about time, you know, and there are no specific questions from the audience. So maybe if I just end something, you know, in a broader note, you know, and we have quite a few people on, you know, dialing in, including very distinguished speakers and panelists, you know, from ADBI and you know, the government bodies and all that. So I'd like to ask this question to all three of you. You know, how do you think, you know, collectively as a community, from a lender's perspective, from an asset owner's perspective, and from corporates and regulatory perspectives, can we, you know, in the face of the proliferation of taxonomies, right, you know, how can we actually work together, you know, to cut across this, across jurisdiction and make sure that, you know, we have finally, hopefully, you know, some sort of baseline standards for taxonomies, you know, that will kind of bridge, you know, what is reality on the ground, what we need to reach our net zero ambitions. Matthew, can I start with you? Any thoughts on this? Yeah.
Short list. I know everything's supposed to be in groups of 5, so I'm still working on mine. I think data is one, so we touched upon that. I mean, actually, data, disclosure, and capacity building all go together. I know we've touched on those things, but data is a challenge for any financial institutions. We don't have the data necessarily internally. We may not be able to find the data from a third-party provider. We may not have the data from an issuer or a client, and that touches on, so that's an issue. Disclosure is another concern. I think you need to complement a taxonomy and policy with disclosure standards. And you need to think about that in a very proportionate way, so that small companies, because often it's sometimes some standards are kind of written and geared towards larger organizations that are able to disclose. You also need to think about the smaller organizations, and then the capacity building. Policymakers and regulators need to think about, you know, capacity building. We may not have complete information. There is uncertainty, and we all kind of need to work together to that. I would say the last point is about just thinking about usability. We need to be very clear about purpose. We need to be very clear in terms of how these things can be accommodated, so that they don't become so complex that they become a compliance exercise.
Thank you. Eugene, final thoughts.
I'll just add to what Matt started off, because I think that's a pretty good list. Discussion between industry and the issuers of taxonomies, I think, is critical. And that shouldn't just stop at the issue of a taxonomy once it's finalized, but, you know, this is an iterative process. Taxonomies have to be living documents, and as Matt said, their usability is critical. So that assistance to industry and dialogue with industry on usability and interpretation is critical. The other thing I think is, you know, with the proliferation of taxonomies, you know, we now heard from Ikeda-san that Japan is trying not quite a taxonomy approach, but a slightly different approach. There's probably 3 key models out there at the moment, 4 if you see the ASEAN one as a significant evolution, which I do. You know, some degree of dialogue between the issuers' taxonomies, whether that's through the IPSF or some other forum, to try and agree principles for the design and interoperability of taxonomies. I think we're getting to the time where that's really becoming quite critical, I think.
Thank you. Helena, you know, if you can add on, I think it's very comprehensive really, but yeah.
I agree. I mean, I substantiate everything that both Matt and Eugene have just mentioned. The data and disclosure element is critical to being able to you know, implement and use the taxonomies, and we know that from our own perspective as a data provider. And we've been creating and collecting green taxonomy data for about the best part of 10 years, and know that, you know, it's actually a very small proportion of companies that you can actually look at the output of what they do and align that with the taxonomy. So that's certainly key. I think discussions between an alignment between regulators, but also with industry participants. And I think, as Matt maybe said earlier on in the discussion, many of the regulators here have been extremely good about engaging with market participants, and that's important, particularly, I guess, in terms of lending some level of input that can add to the development of a more interoperable framework. I mean, I know that we have people who are on both the UK GTAG and also the Singapore GFIT. So, you know, I think that participation of the industry is critical. I would also say that the common ground taxonomy that the IPSF are working on, in principle, is something that would be very useful in terms of having a forum and a platform for regulatory alignment that can take on board all that feedback from the industry and then help to create frameworks that really can be used together and to solve many of those issues. And then I guess just finally, you know, broadening beyond use of proceeds to entity level analysis, so that we're not just talking about sort of fixed income instruments, but also really able to look at what issuers are doing and apply that to asset classes across the board. I think that's also a very important element here.
Well, thank you very much. I think all three of you have been very insightful and very generous with your time. I'm sure, in fact, that the participants have found this discussion very, very informative and useful. And sticking, at the risk of sounding cheesy, sticking to the Star Wars analogy, I'm sure collectively we can be the Luke Skywalker to solving this eventually. So thank you very much, and I'll pass this over back to Keiko-san. Thank you.
Thank you very much, Mr. Tan, for very insightful and a very interactive panel discussion from various perspectives. This is a really evolving process involving various stakeholders. Thank you very much. For remarks on the session for today, we are delighted to have two distinguished speakers from APFF, ABAC, Apex FSDN. First, I welcome Mr. Julius Peranis, Senior Advisor of Daiwa Institute of Research. He is Senior Advisor of Daiwa Institute of Research at the Daiwa Securities Group. He coordinates the Asia Pacific Financial Forum, that is APFF, and represents the APAC Business Advisory Council, that is ABAC. In the APAC Finance Minister's process, previously to this, he has served as Senior Advisor at Mizuho Bank, Nomura Research Institute, and Nomura Securities. Advisor at Mizuho Bank, Nomura Research, Nomura Security Research Institute and Nomura Securities, Advisor on International Affairs of Bank of Tokyo Mitsubishi UFJ, and Senior Advisor Fellow of Institute for International Monetary Affairs in Tokyo. Mr. Peranis, floor is yours.
Thank you very much, Keiko-san. Let me just emphasize what are my key takeaways from the discussions. Transition presents an opportunity for investing in long-term growth and innovation, but only if lenders and investors are provided an interoperable global framework to work with. The opportunity is there, especially in emerging markets where many regulators and the industry are now actively seeking to expand their knowledge and understanding of how to integrate ESG criteria into banking and investment guidelines, regulations, and practices. I think one important thing is the partnership between the public and private sectors. This is critical in developing tangible, actionable, and achievable strategic initiatives in this space. It's particularly needed to create arenas of emerging profitable opportunities, especially the development of new technologies. And within this framework, financial institutions are important enablers because they influence managers on their investment choices. Regulators collaborating with the banking sector, which covers as much as 90% of financing needs in Asia, is important. Being a highly regulated sector where a lot of innovation is also taking place, banking is where much attention deserves to be focused in the region, especially for small and medium enterprises, which make up more than 97% of companies and which employ more than half of the labor force. and obviously without which we cannot reach our goals. So there is a huge need in this space for knowledge and capacity building that must be addressed. Data availability is another critical factor. We have, of course, the TCFD, which provides a framework to help companies to see the risks and opportunities and to manage those risks as well. However, there is still much to be done to improve the quality of disclosure, which in general is not yet sufficiently effective in enabling a view of the scale of systemic risk. Finally, I would like to pick up one thing that was referred a couple of times earlier, and that is that we need an honest science-based discussion of the costs and benefits of transition. For many years, we have had the benefit of a steady supply of fossil fuels that enabled us to undertake steps toward net zero without significant resistance at this stage from consumers and businesses who had the comfort of continued access to very affordable fossil fuels, in certain cases, even subsidized. The situation today, which is the acute shortage of fossil fuels, I think is a good opportunity to have that honest discussion. Transition is not a painless process. There will be losers, and there will be more, and there will be pushback if we don't have clarity and if we don't have a just and affordable transition. Again, the financial sector will be key to this transition, but we need data, we need workable taxonomies, and we need supportive regulatory framework. Finally, organizations like APEC can play an important role in this process by providing a platform for collaboration among key stakeholders. From the private sector side, our Asia Pacific Financial Forum will be pleased to collaborate with APEC in this undertaking through the Sustainable Finance Development Network, which my colleague Pablo will discuss further. So my takeaways: 4 important things: interoperable standards and taxonomies that are workable for this diverse region, data and disclosure, innovation, and collaboration among stakeholders. That means industry, regulators, standard setters, MDBs. So lots of work ahead. That ends my remarks.
Thank you very much, JC, for your sharing your insightful remarks. Really, you have really history of wide, in-depth experiences, and including presentation on the APEC Ministry, Finance Ministry's process and all that. So thank you very much. And unfortunately, this is time to close the first day of the webinar. I'd like to invite Peter Morgan, Senior Consulting Economist and Advisor to the Dean at ADBI, to deliver the closing remarks.
Thanks very much, Keiko-san. First, I'd like to thank Keiko-san and her colleagues for putting together a very stimulating and comprehensive program. We've had a lot of good discussion, and I think highlighted quite a few of the issues involved in transition finance. So I just wanted to maybe give a few takeaways that I had from the discussion. First, in terms of the roles that ADB and international financial institutions and governments can provide, they mentioned the importance of blended finance instruments, and also the importance of developing roadmaps to guide both financial institutions and corporations. And what's also striking is that although, of course, it's necessary to provide incentives for investors, such as banks and other groups, to provide funds for these kinds of investments, but it's also very important to incentivize the firms to make those investments, given the uncertainties that are involved in them, so that there are certainly incentives needed to overcome the reluctance of firms to invest in this area. And I was particularly struck by the comment by, I think, Mr. Ikeda, that even though the roadmaps are being developed, that in many cases the technology is still not regarded as being adequate to reach net zero, so that there is still a substantial both lack of knowledge and uncertainty, which needs to be addressed. And I think that the taxonomies could be regarded as kind of a quantitative regulation, but we do need price regulation too, that we do need the development of carbon markets as a very supportive factor to encourage firms to make the needed investments. And so therefore, I think that the taxonomies are a necessary aspect, but as was brought out in the discussion, they can be very complex, not necessarily very workable. There are lots of trade-offs, and therefore that they probably cannot be the only instrument that's involved in this process, that we need carbon taxation and that kind of instrument too to make the whole thing work. So let me stop there. It's been an excellent discussion. Thanks very much.
Thank you very much for your insights, Peter. I'd like to thank all of you for your time and attendance today. With the closing remark from Peter, we'll conclude our first day of the webinar. Thank you, everyone. We are looking forward to seeing you all again tomorrow for the second day of this webinar, starting 3:30 p.m. Tokyo time. If you have other questions or comments, please submit them in the post-event survey. Thank you very much for your participation.